For years, digital assets moved in lockstep. If Bitcoin surged, everything else surged. If it crashed, it dragged the rest of the market down with it. But that monolith has fractured. Right now, the global economy is exceptionally hostile to speculative risk. The U.S. average effective tariff rate has climbed to 11.1%, the highest level of trade protectionism seen since the early 1970s. To combat the resulting inflation, the Federal Reserve is keeping interest rates elevated. High rates typically drain capital away from risk assets, starving them of liquidity. Curious, this chart shows the anomaly. While macroeconomic pressure is pushing downward, the total crypto market cap is stubbornly holding steady, right around $2.4 trillion. It isn't crashing. Underneath that flat top-line number, capital is migrating. Regulators in Washington, specifically through a new SEC and CFTC Memorandum of Understanding, have formalized a two-lane highway. They are strictly dividing digital securities from digital commodities. Institutional capital is reacting to those new lanes. The days of treating all digital tokens as interchangeable lottery tickets are over. Individual networks are now fighting for distinct financial identities. Bitcoin is currently consolidating in the $76,000 range. It has evolved into a massive, highly liquid sponge for institutional capital. If you ask veteran technical traders, they'll point out that Bitcoin's weekly chart hasn't actually formed a convincing structural bottom. The traditional markers for a price reversal simply aren't there yet. But technical charts are being overpowered by brute force accumulation. A single public company, Strategy, acquired $7.2 billion of Bitcoin in 8 weeks. They now hold a staggering $63 billion treasury, completely dwarfing standard retail market flows. That volume of capital overrides minor chart patterns. Market observers are now watching daily flows into US spot ETFs strictly as a barometer for whether Wall Street maintains this level of conviction. Bitcoin price action is detached from retail hype. It is trading on the deliberate, systemic accumulation of corporate treasuries. While Bitcoin holds near its highs, Ethereum is facing severe friction. Ethereum recently bled to $2,250, regressing to 2021 price levels. Yet institutional appetite is present, with US spot ETFs absorbing $11 billion in inflows. The problem is extreme interest rate sensitivity. A single hawkish Fed announcement recently wiped out $150 million in leveraged positions. Ethereum has massive institutional utility, but it lacks the macroeconomic immunity of Bitcoin's corporate backing. Then there is BitTensor, trading near $250. It operates as an open market price, where participants are financially rewarded for sharing machine learning models. While the broader crypto market flatlines, BitTensor recently saw a 50% surge in daily trading volume. It is generating tens of millions in real revenue from artificial intelligence services. This pie chart illustrates the shrinking available supply of the TAO token. Heavyweight tech investors, including NVIDIA and Polychain Capital, have deployed roughly $620 million into the network. The vast majority of those tokens are staked and locked away, tightening the market. Now, major asset managers Grayscale and Bitwise have filed for spot TAO ETFs. The SEC is scheduled to issue a ruling on those applications by August 2026. BitTensor is ignoring traditional market gravity. Traders are pricing it strictly as an early-stage, hyper-growth artificial intelligence commodity. We are looking at a fragmented landscape. Capital is filtering digital assets based strictly on their specific economic utility. This separation is being engineered directly by lawmakers. Regulatory milestones like the SEC and CFTC agreement, alongside debates over the upcoming Clarity Act, force institutions to legally categorize what they are buying. The next major tests will arrive soon. The Federal Reserve's May interest rate decision will challenge Ethereum's macro resilience, while the August ETF rulings will determine BitTensor's access to retail liquidity. You can no longer buy a random token and assume it will automatically float upward on Bitcoin's coattails. In 2026, correlation is breaking down. To survive this standoff, investors must abandon the concept of a unified crypto market and evaluate these networks exactly as Wall Street does, as distinct technological commodities.